Anyone here? How about now? One more time. How about now? Now you got it, Fred? Perfect. Perfect. Awesome. Thanks so much for your help, Fred. All right, so we're going to go back a little bit. Let me see if I can't get this page to go back. Foundation. All right, so we're here to talk about the business credit score advantage. I'm going to go through this quickly now. Thanks, Fred, for helping me out here. I had no idea that I was muted or wasn't working. So the business credit score advantage, just as personal credit scores open doors to financial opportunities in your individual life, business credit scores unlock critical pathways for your company's growth and sustainability. These numerical representations of your business's creditworthiness directly impact your ability to secure funding, to establish beneficial vendor relationships, and to position your company for long-term success. Throughout this presentation, we're going to explore how business credit scores work, what they actually measure, and most importantly, how you can build and maintain excellent scores that give your business a competitive edge in the marketplace. All right. There we go. So the foundation of business's credibility. Financial separation is the thing we're talking about here. Strong business credit creates a clear distinction between your personal and your business finances, protecting your personal assets from credit and credit from business liabilities. In other words, a separation of church and state here, right? Marketplace trust establishing robust business credit builds credibility with vendors, suppliers, potential partners, customers, opening doors to preferential treatment and to much, much, much better terms. And I mentioned this earlier when my mic was off, but what's important to know here is that no one needs your permission to pull your business credit report. So customers can pull your business credit report, competitors can pull your business credit report. It was one of my favorite tricks when I was competing on a big project. I would find out who was bidding on the job and I would pull their business credit report. And then if it wasn't strong, I would take it right to the customer and be like, you sure you want to do business with them? So having a strong business credit report absolutely will impact your business. And it's going to offer you growth opportunities. Understanding and improving your business credit scores can help unlock better funding options with higher limits, lower interest rates, fueling expansion. And believe it or not, there are some customers, I know someone in the trucking business that tripled their business just because all of a sudden they were getting invited to bid on contracts because their business credit scores went up. They had no idea. They were like, how are we getting all these opportunities to bid? That's where it was coming from. All right. So that's great, Steve, but how are business credit scores generated, right? Well, first of all, it's all data collection, right? Credit bureaus gather information from vendors, from lenders, public records, and sometimes self-reported data to build your business's credit profile. And I say self-reported data, I'm talking about you supplying information to the business credit reporting agencies. Obviously, you're only going to supply the best information. If your business is losing money, you don't want to send in financials. If it's making really good money, it's profitable, send those financials into D&B as a classic example. That's only going to improve your credit scores. This part two of how they're generated is through analysis, right? This information is processed through proprietary algorithms that weigh various factors differently depending on the bureau and the scoring model. And we're going to dive into those in a little bit. And then what happens, it comes out the other side, it's score generation. The analysis produces numerical scores that lenders and vendors use to assess the risk of doing business with your company, and then that also determines credit limits. So, the continuous monitoring cycle. Step one, new data is reported. Vendors and lenders regularly report payment activity and account status if you know who to use. And then the scores get updated. Credit bureaus recalculate the scores based on all this new information. Typically, it comes in every 30 to 45 days. Then your ongoing financial decisions and payment behaviors create even more data. That's part three in the monitoring cycle. And then we get to four, and that's where regular monitoring identifies changes and opportunities for improvement. So, like a pie, right? First step, vendors and lenders, if you have them that are regularly reporting, they're going to report what you're doing. Your score gets updated. You make a decision, pay your bills on time, pay them late, whatever it is, whatever way your payment behavior goes, and then the report gets updated, and then you're going to review it. This ongoing cycle means your business credit scores are dynamic, reflecting the current financial behaviors of your business right now and your payment history alone. Consistency in payment practices and financial management is essential for maintaining really good business credit scores. All right. Did I go backwards? I did. There we go. So, payment history. This is literally is the cornerstone of business credit. This is really where the majority of your score is coming from. Timely payments, consistently paying your vendors and lenders on or before the due date establishes a really, really strong foundation for excellent business credit. The single factor often carries the most weight in credit scoring models. Little pause here. So anybody who's familiar with personal credit knows that your personal credit score is made up of a series of items: how you pay your bills, what your debt to or what your utilization rate is, and utilization rate is about 35% of your personal credit score. 35%, right? In the business credit world, your payment history is weighted the heaviest. How you pay your bills is weighed more than anything else. There are some credit reporting agencies that weigh in your utilization, but it's such a lightweight, it barely impacts your scores. It's really about how you pay your bills, right? So late payment has massive impact. Even occasional late payments can significantly damage your scores with later payments. When I say later payments, 60 plus days, right? Causing more severe and longer lasting negative effects than minor delays. Uh, Typically, and we're going to talk about scoring models and what a good score is and what a good score isn't in a few minutes, but typically you can pay up to 30 days late because that's pretty normal in the business world. Uh, Payment patterns. Credit algorithms look for patterns in your payment behavior and with consistent on-time payments across multiple accounts, creating a positive narrative about your business's financial abilities or reliability, excuse me. All right, credit utilization. Just touched on this, right? So your credit utilization ratio, the percentage of available credit you're currently using, uh, definitely impacts your scores. Lower ratios, generally under 30%, signal responsible credit management and are viewed favorably by lenders. Now, again, it's not as impactful as it is with personal credit. Also, what they're looking at is revolving versus installment. Revolving credit, like business credit cards, typically affects utilization more heavily than installment loans. Managing revolving balances carefully while maintaining a diverse credit mix demonstrates financial sophistication, just like your personal credit. Available credit. Maintaining open credit lines, even when not actively using them, can improve your utilization ratio. However, unused accounts should occasionally show some activity to prevent closure by the creditor. That's important. I know people that will open up a business credit account, get one trade line reporting, never use that source again, and then they get disappointed when they go back a year later and that trade line is gone because they didn't use it. It costs money for them to report. Financial health indicators and credit scoring. First, revenue streams. Stable and diverse revenue sources demonstrate reduced vulnerability to market fluctuations and improved perceived creditworthiness. Two, asset-based. Substantial business assets provide collateral potential and indicate business stability, positively influencing credit assessments. In other words, if you have stuff they can leverage, that's awesome. Uh, Debt to equity ratio. Lower ratios suggest better financial health and less risk, as they show a business isn't over leveraged relative to its value. So debt to equity be, if you're worth $1 million and you owe $1 million, that's 100% debt to equity ratio. You're not looking real strong there. Profitability trends. Consistent or improving profitability signals the business sustainability and that you're able to manage your debt obligations. And then liquidity measures. Strong current ratios and cash reserves indicate the ability to cover short-term obligations and reduce credit risk. So, industry risk factors, that's actually in your credit evaluation as well. Sector volatility. Some industries face inherently higher risk assessment due to cyclical demand, regulatory challenges, or technological disruption. Businesses in these sectors may need stronger financial metrics to achieve the same credit scores as those in a more stable industry. Most people don't know that, right? Competitive positioning, your business market share, your competitive advantages and growth trajectory relative to industry peers factor into risk assessments, with market leaders typically receiving much more favorable evaluations. And then economic sensitivity. Industries highly sensitive to economic cycles like luxury goods or construction may face additional scrutiny during credit evaluations, especially when economic indicators suggest potential downturns that are coming or you're entering, right? So what all of this basically means is you want to be careful when you pick your NIAX code and pick the industry you're in, because you are going to be considered high risk if you pick the wrong one. I was in real estate. That was one of my industries. That's a high risk industry. And it's much more difficult to build a strong business credit profile if I pick the wrong NIAX code. you're unsure about that, we'll talk about at the end how you can schedule an appointment with my team and figure out the right way or the right NAICS code to choose. So these are the major business credit bureaus, right? So you have your Dun & Bradstreet. Dun & Bradstreet's been around forever. Everyone knows who they are, D&B. You hear people call, they talk about your DUNS number, right? Your primary score range is going to be from 1 to 100. They call it a PAYDEX score. Now, what's a good score indicator for Dun & Bradstreet? 80 plus is really good, right? 78 plus is actually considered good. And 78 means you pay mostly on time, but every once in a while you might fall behind. Let's say it's net 30 terms, maybe you pay in 45. These are typically for trade references, and the emphasis is really on your payment history. Then the next major business credit bureau is going to be Experian Business, right? That's going to give you an IntelliScore Plus. It's 1 to 100. You want to keep your score at 76 plus. This is predictive analytics, blended data sources. Most people don't understand Experian, and I can tell you it's a very specialized report. I'm sorry, not Experian. I was thinking about Equifax. Experian is where you're going to find a lot of your lenders will pull that one first. They may pull all three or a blended version of all three, but Experian is where your credit card companies tend to look. It's where your cash lenders tend to look. And then you have Equifax Business. This is the one I was originally talking about. That's a 101 to 992 credit risk score, it's called. You want to keep that around 700 plus. This is a broader range, broader score range. It's detailed business intelligence. It adds a lot more than just how do you pay your bills. Then there's the one that I love is the FICO SBSS score. This is going to be between 300 and 850. Kind of sounds like personal credit, right? Real close. You want to be 680 plus for SBA loans. If you want to get an SBA loan, this is used specifically for loan decisions, and it does integrate your personal credit. So your business is standing alone with D&B, Experian, and Equifax. With the FICO SBSS, that's going to blend in your personal credit as well. How are we on time? All right, we're rocking and rolling. So first thing you want to do is you want to build your business credit foundation. If you haven't done that, you want to start with establishing a legal structure. Form an LLC or a corporation to separate your business identity from your personal finances. This foundation step creates the legal framework necessary for building a dedicated business credit. It cannot be a sole proprietorship. It cannot be a partnership. That is basically personal credit, right? When you're a sole prop, you are the company. So if you're going to build credit, it's going to be personal credit. Everything's going in your name. If you're a partnership, it's basically the same thing. You want to have it a minimum as an LLC. Then you want to secure the EIN number, obviously, from the IRS, register with the appropriate state and local agencies. These official identifiers legitimize your business in the eyes of the creditors. Even if your business doesn't need a license in your state, get a business license. It just adds credibility, and I think it costs in most states anywhere between $100 and $200. I would 100% get a business license. Then, of course, you want to create a business bank account, open a dedicated business checking and savings accounts to establish financial history and demonstrate proper separation for personal finances. This is a key factor in business credibility, and honestly, with the IRS, it's a key factor. So you want to make sure you have a business bank account. If you don't have that, stop what you're doing, open one today. Then you want to register with the credit bureaus. You want to proactively create profiles with the major business credit bureaus, particularly Dun & Bradstreet, by obtaining your DUNS number, which we touched on, to ensure your positive activities are properly tracked. I can tell you the other ones will automatically create a profile. You're going to want to verify that. Is the minute you get credit, it's going to create a profile. But with Dun & Bradstreet, you want to register for your DUNS number. It is free. You don't have to pay for it. Okay. So now that you're registered, you've got your business going, everything's good. You've got your bank account, you've got your EIN number, you're registered with the credit reporting agencies. Now you've got to establish some initial trade credit. You want to start with vendor relationships. They're the easiest to get. Identify suppliers who offer net 30 terms, and this is the key, actually report to the business credit bureaus. You're going to find places like office supply companies, some wholesalers often provide starter trade lines that help establish your initial, shipping companies, as a matter of fact, to establish your initial credit history. You want to pay early or on time. You do not want to pay late, specifically early in the game, right? So you want to pay on or before the due dates to build a positive payment history. With D&B's PAYDEX score, early payments can actually earn you a higher score than merely on time. So in other words, 80 is on time. Anything above 80 means you are expected to pay early, okay? Then what's going to happen is you start with the smallest purchase amounts and gradually increase them as you build rapport with the vendors. You want to request credit line increases after establishing several months of perfect payment history. Honestly, it goes very quickly. I was able to build up to six figures with hardware suppliers, big name companies. You all know them out there. I started off with approvals for 5 grand and built it up to over six figures. It was great for my real estate flipping business, but you have to ask for it. You have to build rapport with your local location or whoever you're buying from, and then ask for those credit line increases. Then, this is important. You want to monitor because you want to confirm they're actually reporting. You want to verify that your vendors are actually reporting the payment history to the business credit bureaus. If not, you want to switch to suppliers who do, or ask current vendors to begin reporting. Okay. Now, the problem you're going to run into is that while almost 100% of suppliers will report if you don't pay them, only about 7% report if you do. So we can help you with that. If you want to find out more information about that, I'll give you a way to do that at the end of this presentation. So now you've got this business credit. Now you want to begin leveraging it, and you want to do it strategically, right? So we want to talk about business credit cards, right? You want to select the right cards. You want to choose business credit cards that report to the business credit bureaus rather than just personal bureaus. Matter of fact, you don't want a business credit card that reports to your personal credit bureau ever, right? Because utilization has direct impact, right? You just don't want that debt showing in your personal credit report. You want to look for cards that offer rewards aligned with your business spending patterns and reasonable annual fees relative to the benefits provided. You want to maintain low utilization. Now, this doesn't mean you can't max out a business credit card. What it means is you better understand the billing cycle and get it paid down below 30% before the next billing cycle. That way it doesn't report as maxed out, right? Because you still want to maintain favorable utilization ratios. Consider making multiple payments per month to keep reported balances low, even when cash flow requires significant card usage. All right. And then set up automatic payments for the least minimum due to avoid any late payments. For maximum credit benefits, obviously you want to pay in full each month while maintaining regular usage to demonstrate active, responsible credit management. That makes sense. You would do that in your personal credit world as well. Monitoring your business credit reports. Now you've done it. Now you've got some vendor credit. You've got some business credit cards. Now you want to monitor your business credit reports. This is important, right? First of all, strategic response. You want to address issues and capitalize on improvement opportunities right away. Detailed analysis. You want to identify trends, errors, and factors affecting your scores, and you want to do that early in the game. Then, of course, regular monitoring. You want to check your reports from all major bureaus at a minimum quarterly, right? If you're beginning to build business credit, you want to check that monthly as things begin reporting. But if you're not building anymore and you're just operating, at least quarterly, you want to pull them because you never know what can show up on there. There are multiple reasons why that's so important. If you're interested in finding out, you can always schedule time with our team. So regular monitoring forms the foundation of effective credit management. By checking your reports from all major bureaus at least quarterly, you will establish a baseline for understanding what's normal for your business, and you can quickly spot any anomalies or any errors that are happening. When analyzing your reports, look beyond the numerical scores. Don't just look and be like, hey, I got an 80 paydex score. You understand specific factors that are influencing them. The detailed examination helps identify both immediate issues needing correction and opportunities for strategic improvement with your credit profile. For example, most people don't know this, business credit reporting agencies will recommend a credit limit for you. So early in the game, you're going to find it's $1,000 typically. As your business credit profile grows, they will keep increasing that credit limit recommendation. Well, let's say you're working with an office supply company and you just buy lots of office supplies and you have a $1,000 approval with them because you applied to them early and they approved you based on what the credit reporting agencies were reporting. Well, you're monitoring your business credit and you're doing well and you're paying your bills and you look and you realize, man, they're recommending me for 10 grand now. Go ask for it. Go back to, if you're continually using that office supply company, go back and ask for a $10,000 line. Ask them to increase it to 10 grand. You want to develop a systematic approach to addressing identified issues, whether it means disputing inaccuracies, adjusting payment, restructuring credit accounts. You want to optimize your business credit standing. That's the bottom line. All right. How are we doing on time? We are rocking and rolling. All right. So here's the benefits of strong credit scores. You're going to get 50% higher approval rates. This isn't hyperbole. This is absolutely what I see happening every single day. Businesses with strong credit scores experience significantly higher approval rates for loans, credit lines compared to those with poor limited credit histories. You know, If you were going to one of those big box stores as a real estate investor and you ask for credit, the odds are you're going to get 2 to 5 grand if you have a really good personal credit score. I had 6 figures with both of those stores. That's a unbelievable increase in what's available and what's typically available. You're going to find the average established small business with excellent credit can access over $65,000 in revolving credit facilities, substantially more than businesses with fair or poor credit. You're going to find interest rate savings. This is the kind of the what I call the ghost stat that people don't think about, right? Looking for a $100,000 line of credit, and you get approved, and you're super excited, and the rate is 9.7. Well, you're excited because you wanted that 100 grand, but now you have to start paying back that 9.7% interest. You have a strong business credit profile that could look like 6%. It's massive. It's 33% less, right? So small businesses with top tier credit scores typically receive interest rates 4.2 percentage points lower than those with poor scores, generating substantial savings on financial purchases. And then there's a 30%, there's the growth advantage. Businesses with strong business credit profiles have a 30% growth advantage. I gave you an example of that trucking company. They were building their business credit just to build business credit. They were sick and tired of being put in financial checkmate using their personal credit. So they built their business credit score, we're doing tremendous with it. But then out of the blue, they started getting contract offers to bid on other opportunities. And they didn't know where they came from. They didn't have a sales team out going after them. The suppliers, the people who were providing the contracts, were pulling business credit reports of local trucking companies that were large enough to handle these contracts. And when their scores kept skyrocketing, they were like, they're trustworthy. They're going to produce. They pay their bills on time. They're not going to take our money and stiff their drivers or their suppliers or their vendors. So that their business skyrocketed. It more than 10x. So that's a huge advantage with a strong business credit profile. And I told you, I use that in my printing business. If I was bidding against your company and we were bidding on the same contract, the very first thing I did was pull your business credit reports. I wanted to see what was on there. I wanted to see if you were paying your bills on time. God forbid you weren't. You weren't, because I would leverage that. I would take that right to the head of purchasing, be like, here's mine, here's theirs. The problem here is if they don't pay their suppliers will not deliver your product. You could be all the way through the end, and the supplier's like, nope, holding it for cash. Now you're in trouble, right? Your product's not getting delivered on time. That's a big problem. That's why I love business credit as well, right? So there's ideas, ways to leverage it outside of just what your score is. So taking the next step, schedule a credit consultation, get expert guidance on your specific situation. And this is really important. So I have a team of finance strategists. What we do is we meet with business owners and we lay out a plan for free, doesn't cost you anything, in the best way for your business to move forward to get any type of funding it's going to need, not just today, not tomorrow, but over the life of your business. We lay out a plan with you, go through what your needs are, what you're looking to do, what your growth goals are, and then we design a plan. If it's strictly just to build business credit because you're not interested in funding yet, no problem. Let's show you how to do that. Oh, I want to get some funding and I also want to focus on my business credit. We're going to show you the best way to do that. If it's something that we can't even help you with, we're going to send you to the people who can, right? You want to implement best practices, apply these strategies covered in this presentation, obviously. You want to monitor and adjust, track your progress, refine your approach. Never be afraid to ask. Never be afraid to ask, because it's amazing how many times you're going to get a yes. Building strong business credit is not a one-time effort, right? But an ongoing process that requires attention and strategic management. Every CFO in the country monitors their company's business credit profile. It's important to do that. By implementing the best practices we've discussed today, you can significantly improve your business's credit profile over time. It's a pretty quick time, though. Remember that each positive step compounds, creating a stronger financial foundation for your business, whether you're just starting to build business credit, you're looking to improve your existing scores. Consistent application of these principles will yield real, meaningful results. For personalized guidance tailored to your specific business situation, just schedule a consultation go to creditsuite.com/consult. I'm going to say that out loud again, creditsuite, SUITE.com/CONSULT consult, where you can schedule a meeting. We can develop a customized roadmap to optimize your business credit and teach you how to leverage it, to be honest with you. I think this is my last slide. I hope, did we do it right on the nose? 30 minutes. Outstanding. Love it. Thanks so much for visiting with us today. I look forward to seeing you again. I'm Steve Weibel at Credit Suite. Again, give us a shout at creditsuite.com/consult. Get your consultation scheduled. Meet with our financial strategist. Let's design a plan for you to grow your business. Take care.